Hi, I'm Ed Alexander, business attorney and founder of Alexander Abramson. Welcome back to our video series on partnerships and partnership agreements. In this video, we're going to talk a little bit about partners leaving the partnership. So there are two ways that a partner can leave a partnership, right? They can leave it vertically or they can leave it horizontally, right? So either they're carried out on a stretcher or they walk out the door. And of course, carried out on a stretcher is the worst case scenario, right? But interestingly enough, it represents one of the easier situations to deal with, right? Because we can insure for a partner either dying or becoming disabled, and those insurance proceeds can be used to buy out the partner. This is the most common clause that you'll see in a partnership agreement. But it's very important that we talk about valuation in that context, right? There are a number of different ways to value the partnership. In the context of a partner dying or becoming disabled, it's important that really there are two that we focus on. One is what's called a certificate of value. And that's where the partners literally get together and decide what the value of the partnership is, or the value of the business is at any point in time. Now this works great because it's simple. The problem is partners don't usually go back and reevaluate that, right? So they'll do it at the time they sign the partnership agreement, but 5, 6, 7, 10 years later when somebody dies, we'll still have the value that was signed on the day that the partnership was signed. And so the first person to die, their family loses a lot of money because usually that's a much, much lower value than the true value of the partnership 8, 10 years later. And so the other way to do it is we can have a valuation formula. So we can say, hey, this is often the case with, say, membership in gyms and things like that. All right, for each person that is a member of this gym, the value of the company is $10 or $15 or $20 or whatever the number ends up being. And then we multiply that out and we come up with the value of the business. Formulas are great because they're easy. The problem is that maybe the business changes over time. And again, the partners, if they change the business over time, would have to come back and revisit the partnership agreement, and that formula will be baked into the partnership agreement. Okay, so the other way to do this is through a full-blown valuation, and the beauty of that is it's probably the most accurate valuation of the company at the time. The downside is it tends to be expensive and it tends to take some period of time. So what we typically suggest is that the partners get together and do a certificate of value. So they establish the value for themselves, and then ultimately if we put a shelf life on that. So maybe it's 18 months, maybe it's a year, whatever the case may be. And then if they can't get together, the default would be the valuation. This incentivizes the partners to actually get together because they don't want to take the time or pay the money for the valuation, but it also protects that in the event that they fail to do that, then the first to die does not suffer a loss of value associated with that. So that's kind of partner departure in terms of death. We do want to insure for that. It's very important that the insurance policy be structured properly for that. And then there obviously are partner arrangements where partners leave in the middle. We're going to talk about exit strategy, so that's going to be a little bit different. But it's important to make sure that the partnership agreement prevents a partner from making a transfer to someone else, because at least in theory, you all have gotten together because you know, like, and trust each other. You don't want to be in business with somebody who you don't know, like, or trust. And so one of the things that often comes up here is that the partners will own individual LLCs or individual corporations that then will own an interest in the main business, the main partnership itself. And if that's the case, then obviously we have to tie the transfer not only to that LLC that's the owner, but also to the ultimate actual partner in the partnership. And so the provisions in the partnership agreement should reflect who the true partner in the deal is, even if from a business and from a tax standpoint, that isn't the partner receiving the K-1. So the issue of transfers is really where the corporation entity versus the LLC, limited liability company entity, diverge. Because in a corporation, stock is traditionally transferable. And so in your partnership agreement, you want some restrictions on those transfers, especially if you're an S corporation, because an S election can be lost if the stock is owned by somebody different. But this is really prevalent in the case of bankruptcy, or in the case of bankruptcy of a partner, or of divorce or death of a partner, because in some cases that stock then could be distributed to a spouse or to a creditor or somebody like that, and you could end up being in business with a creditor or somebody that you don't know. This is less problematic in the context of a limited liability company, because those interests where you have a multi-member limited liability company, those interests are not readily transferable. Because if somebody comes in, if a creditor comes in, if a former spouse comes in as an owner, what happens is they don't become a full member in the company. They merely get the right to receive the economic interests. Now, they can cause some problems, because obviously what we don't want to have is the partners having some fiduciary or other obligation to the former spouse or to a creditor. And so we have to be careful about what that looks like. And the partnership agreement should contain provisions that allows either the partners or the entity itself, the LLC, to buy back an interest from a former spouse, from a creditor or whatnot, at certain pricing and on certain conditions. If you're planning a new business partnership, or if you have an existing partnership and don't have a partnership agreement, or haven't reviewed that partnership agreement in a long time, call or email us to set up your partnership design session. We'll walk you through these 21 areas and set up a comprehensive partnership agreement that works for your business and that will enhance its value. Thanks for watching.